Okay, so in this lecture, I'm going to talk about gambling preference of investors and how those behaviors impact the financial markets in outcomes. So the papers we're covering in this lecture include 4. One of them is just added to the syllabus, right? The first one is Alok Kumar's article on individual investors' gambling preference in the stock market, this one. And the second one is Kumar, Page, and Spelled 2011, published in Journal of Financial Economics, on religious attitudes, religious belief, and gambling attitudes, okay, which talk about how religious beliefs can be used to proxy for the attitudes towards gambling and how that attitudes would impact option granting by firms, IPO pricing, and etc. The third article, which is going to be the focus of my talk, is an article I wrote with Doran and Peterson, published in 2012 in Review of Finance. Okay, and it's titled "Gambling Preference and the New Year Effect of Assets with Lottery Features." And the last one, which I'm going to briefly mention at the end of my talk, is another article I wrote with my former doctoral student, Kelly Bergsma, and published in 2016, Financial Management. Okay. So the first, the article I'm going to focus on is the Review of Finance paper published in 2012. And this article, by the way, I first introduced Review Finance. Review Finance is the official journal published by European Financial Association. And it's listed since 2-3 years ago. It has been listed among the Financial Times business journals. So Financial Times business journals consist of 50 plus important business journals that are used to rank business school research ranking. So it has been placed a lot of weight in many top tier or excellent business schools if you can publish as a faculty in one of those or in those FT Financial Times journals. Okay, but at that time when we published the article, Review Finance was not among the FT journals. It was later added a few years ago. Okay, so in this article, we're going to show that the New Year gambling preference of individual investors impact prices and returns of assets with lottery features. Okay, so we're going to talk about the options, stocks, as well as international markets such as China, and how financial securities perform around the new year in relation to gambling preference. Okay. So let me start with the definition of gambling preference, right? So there's many ways of calling gambling preference. Some people are saying it's a preference for skewness, but it refers to the tendency of investors or individuals to speculate with a part of his wealth, right? So this has been documented back in 1948 to be the puzzle, right? Why people buy insurance as well as lottery, right? If you buy insurance, you are risk averse. But if you buy lottery, you're risk seeking because you're supposed to lose money on average. And the preference to buy insurance as well as lottery are considered to be puzzle, but it can be explained by behavior portfolio theories. And Stadman 2004 talk about the fact that individual investors tend to under-diversify can be explained by their preference to gamble. So it's lottery preference, right? Lottery play preference. And Kumar 2009 article, which I mentioned in the roadmap, he was among the first one to document individual investors' preference for lottery-like stocks using brokerage trading account data. There are also theoretical developments from 1950s all the way to the recent decades, showing that preference for skewness or preference to gamble would result in overpricing of high skewness securities. There's a lot of evidence, actually after Kumar 2009 article, showing that investors do exhibit gambling preference, and those preferences do impact financial market outcomes. Right? For instance, Kumar's article shows that individual investors would demand lottery-type stocks, and such demand tends to increase during economic downturns. And also, he finds that lottery investment levels are higher with favorable lottery environments. And people tend to overpay for lottery-type stocks because lottery-type stocks tend to underperform. And also the article by Kumar et al. In 2011 JFE, they used Catholic to Protestant ratio to proxy for gambling preference. They find that regions with a higher CP ratio have stronger propensity to hold lottery type stocks. Okay, and IPOs in regions with high CP ratio also experience an average higher first day return. Okay, all of those are evidence suggesting that investors do have gambling preference in the security in the financial markets. Okay, so what's different from the previous research relative to our article is that we don't look at gambling preference on average. We focus on gambling preference of investors at the new year, at the turn of the new year, right? So why we specifically focus on new year gambling preference? The reason is anecdotal evidence has shown that people have stronger preference to gamble around the new year. Okay, for instance, lottery plays, casino gambling, home gaming are very popular as a celebration of the new year. And historically in the US, and it has been offered from Christmas to New Year, a raffle ticket, right? Some kind of lottery games, which is called a New Year millionaire, right? And people would buy the lottery and hope they become a millionaire at the start of the new year. So taking the data, let's see whether it is true that anecdotal evidence saying people do gamble more around New Year and they want to gamble more. The data we gathered here is from Las Vegas Strip. So Las Vegas is known to be the gambling city of the United States and the world. Las Vegas Strip is a long shopping and gambling center in Las Vegas City that has the concentration of famous resorts and casinos. We gathered the data from 1997 to 2007. Okay, it's monthly data for 11 years. Then we look at the per capita gaming revenue. So we take the revenue of Las Vegas Strip divided by the total number of visitation to Las Vegas at that month. As you can see that the red bar, which shows the January average gambling, revenue per person is higher than the yellow bar, which is the average gaming revenue per person in non-January months. So we focus on January because we only have the monthly data and we don't have finer frequency data. But the term of the new year will be included mostly in January. That's why we look at the difference between January versus the rest of the year, and January being the proxy for the new year month. As you can also see from panel B, that if we compare month by month, taking the average of the data across the 11 years, it's clear that in January, the red bar, right, we have a red bar or the purple bar, depending on your measure, you always have the highest gaming revenue per person or population per capita relative to any other months of the year. So the data from Las Vegas Strip gaming revenue shows that indeed people tend to gamble more in January, which is the New Year month in the United States, than in other months of the year. The second piece of evidence we gather to support the New Year gambling mentality is to look at the lottery ticket sales, right? So there are only a few lottery games that can be sold across state lines, okay, including Mega Millions and Powerball. Okay, and most of the lottery sales will be state specific. You can only participate in the lottery in a given state. You cannot sell the ticket to a lottery across state line unless it's approved. For those two biggest multi-state lottery play, we used the weekly data collected from different counties and cities. It took a while for us to gather the data. And we look at the weekly sale, then we define the 2 weeks before and the 2 weeks after the new year to be the new year week. So we set it to be a dummy of 1. The rest of the week, we will set it to have a 0, the dummy of 0 for New Year dummy. As you can see that when we run the regression with fixed effect of the state, right, with the December dummy, with the number of states participating in the lottery, with the change in jackpot size, we find that New Year dummy is always positive and significant, suggesting that people do tend to purchase more lottery tickets at the turn of the new year. Okay, so now we have gathered evidence from Las Vegas gaming as well as lottery sales to prove the concept that individuals tend to gamble more in the new year. Now let's turn to financial markets. If that's the case, how does that new year gambling mentality impact financial securities pricing? So the first segment of the market we look at is US equity, US stocks. We look at whether stocks with lottery features, we call lottery type stocks, that tend to outperform other stocks, the stocks with weaker lottery features, in particularly in January, right? Because people tend to gamble more at the turn of the new year, so they tend to buy more lottery type stocks that push up the prices of lottery type stocks relative to other stocks, which creates this January lottery type stocks premium, okay, which we will show will be corrected in the remaining months of the year. So how do we define lottery stocks? We did this by following prior literature, by using price. So a lottery ticket should have low price, high volatility, and high skewness. And that's what we use to define lottery type stocks, right, through ranking. And we constructed a lottery index, okay, which refers to the top 10% of the stocks that have the strongest lottery features here, versus the non-lottery stocks, which refers to the 10–20% of the stocks with the weakest lottery features. As you can see that so those are all referring to lottery type stocks minus non-lottery type stocks returns, right? So in January, you see all of those 4 bars are positive. It doesn't matter how you measure lottery features. You can use either of the 3 or the combination of the 3, and you see that lottery stocks outperform non-lottery stocks, right? So this is our January lottery stocks premium. In contrast, for February through December, which is the rest of the year, you don't see lottery stocks outperform at all. If anything, there is evidence of underperformance of lottery stocks in non-January months. So that's the key results from the stock market, which we're gonna push a little bit deeper and show the depth and breadth of the results, right? If we go to the options market, right? So the options market, we look at call options versus put options, right? Call options is bullish. If you want to express your sentiment, bullish sentiment, you buy call options. Otherwise, you buy put option if you have bearish view, right? Now we hypothesize that investors who want to gamble, they will buy call options because it's more intuitive, it's a bullish view expressor. Then they're going to buy more OTM, which is the out of money call options, the more ATMs, which is at the money call options, right? So OTM is more leverage, is cheaper and lower price, high volatility, high skewness. It's a better, it helps better to express the bullish view from individual investors. So we hypothesize that OTM options will enjoy a price appreciation in January relative to ATM options than in non-January, right? So one of the students asked me about diff and diff, and this is actually an example of diff and diff, right? Because we're comparing the implied volatility, which is a measure of relative option pricing, right? So the higher the implied vol, the more expensive the option would be, right? So you can think of the implied vol is sort of like adjusted, standardized price of options. So we're here doing a diff and diff, which is comparing OTM and ATM implied vol, and then we compare that difference between January and non-January months. You can see that OTM options are more expensive than ATM options all year round, but this relative difference, this is relative expensiveness is more pronounced in January than in other months of the year. And the difference is statistically significant. Okay, and if you look at option volume, you see the same trend, right? People tend to buy more call options relative to put option, relative to OTM options, relative to ATM options, especially in January. So you see a positive diff and diff, and significant difference here. And that suggests that investors do express their bullish view in January, right? Gambling view in January through gambling, through buying OTM call options. Lastly, we show that this buying activity or behavior, right? Buy more call relative to put, right? This bullish behavior, right? Buying all the money call comes exclusively or focus on come mainly from small investors, right? So this is all investors that's labeled as customers, okay? And versus firms. Firms are institutions for sure. Customers are investor accounts. But this difference is stronger for the investors that place small orders, right? 1 to 10 option contract per trade versus 11 to 49 versus 50. So the higher the number of the contract, the more sophisticated the investors are likely to be, and the less they exhibit this new year purchasing of call options. Okay, so that's the evidence from the options market. Now going back to the equities market, we did do some regressions, right? Not regression, sorting, right? So sorting, basically we look at the sorting of stocks from weak to strong lot of features into quintiles. Then we look at the difference between January versus non-January. Then we report the value weighted portfolio returns versus equal weighted portfolio returns. And the key is here, right? If you focus on the alpha with the long short, strong minus weak, it's all positive and significant in January, but negative and significant in non-January months. So this is very important results because previous paper before us always lumped January and non-January, and they find a very mixed finding whether lottery stocks tend to underperform. We show that once you separate January from non-January, you have very robust and clear evidence that lottery type stocks tend to overperform in January, but underperform in the rest of the year. That's extremely important and also very new finding. And our paper was later cited by many articles, and in part because of this result. Okay. Now we know that in January, lottery type stocks tend to do better. In the rest of the year, they tend to do worse. So let's focus on January. How do we best exploit this January gambling mentality towards buying lottery type stocks, right? So we can do a trading strategy by buy along the top 20% of the stocks with the lottery strong lottery features, and short the bottom 20% of the stocks with weak lottery features. And let's see how much money the strategy can make, right? Of course, we have to adjust transaction costs, liquidity later, but this is not results without adjustments, right? If we don't consider transaction costs, liquidity, and this strategy works fabulously, right? From 1964 to 2007, you only do the strategy once for 1 month and once per year. The rest of the year, you don't do anything, right? And you can enjoy very high returns. It's nearly positive for all years except 1 or 2, right? So in 2001, this strategy has enormous returns. So in 2001, January, that's actually the peak of the technology bubble, right? So it captures a lot of sentiment, which you can see here, right? So that's the results. But after we adjust for transaction costs and liquidity, and the magnitude is of course reduced, but it still remains statistically and economically significant. Okay. So now let's look at in a finer grade and how those lottery type stocks perform surrounding the New Year's Day, which is January 1st, right? Because this helps us to distinguish our finding, which is based on gambling preference, from traditional hypothesis for the size effect, which is like tax loss selling and things like that, right? So if it's tax loss selling or window dressing, this effect should occur only to losers, right? Or institution buying stocks. But that's not what we find. We actually find it's actually applied to both winners and losers. It applies more to retail buying stocks instead of institution buying stocks. Right? So this is the charts that we can see that just focus on the blue solid line, that this is high lottery stocks, the top 20% of stocks with the strongest lottery features. And you can see that this behavior is really concentrated around the New Year's Day. It's roughly 5 days before and 14 days, 15 days after the New Year that you see positive and abnormal returns for lottery type stocks, right? So this tells you this is really to do with New Year mentality. It's not its strongest in the 5 days surrounding the New Year, right? That's consistent with the gambling hypothesis. If you want to look at the difference between institution buying stocks versus retail buying stock, right? We're saying this is probably more driven by retail investors than by institutional investors, right? But window dressing says that's caused by institutions. As you can see at the top, we look at the stocks that are bought, right? This high lottery type stocks by retail investors. You can see that if retail investor buy them, right? This is low lottery type stock, this is high lottery type stocks, and this is low, this is high, right? If it's retail buying lottery type stocks, it doesn't matter how you identify whether they're more like institutional retail holding stocks, and they tend to underperform, right? So those stocks, based on measure, tend to be held by retail investors more than by institutional investors. We find that if retail investors bought those stocks in January, those type of lottery stocks tend to underperform towards the end of the year, right? So the entire abnormal returns in January and is offset by the subsequent underperformance. But if you look at the institution buying stocks, right? So this is institutional stock that bought in January, and even you follow the lottery type stocks towards December, you don't see significant negative returns. Okay, it becomes zero return. It's still underperforming non-lottery stocks, but it's not as bad as the lottery type stocks bought by retail investors. Okay, so taken together what we have from the previous slides and this slide showing that this is really related to the New Year mentality as well as retail buying, not really institutional buying, not really every day, but surrounding the New Year's Day. Okay, so people say, why do we want to gamble in the New Year, right? We said it's a form of celebration. It's a form to try your luck, right? So this is an anecdotal quotes we have from one of the local newspapers in Las Vegas, right? And it's actually talk about, on ordinary days, you want to be disciplined. You don't want to waste your money, but on New Year's Day, it's your day off. You can do a little bit of the things that you would not normally not want to do. You can say goodbye to your moral sense for the holiday, right? And the reason I mentioned about this quote is talk about this mentality to gamble, to celebrate, and to have a day that's different, right? It's also because this article actually talk about Las Vegas bets big on Lunar New Year, right? So Lunar New Year are celebrated by Chinese, and usually it's towards the second half of January to the first half of February, right? And a lot of Chinese Americans or Chinese tourists also fly to Las Vegas to gamble to celebrate Lunar New Year. So this is saying that in some cultures, such as in China, when New Year's Day is different from January 1st, we may be able to identify a New Year mentality, a New Year gambling mentality that's different from the January gambling mentality. So that would be a very interesting test to see whether it is January that's driving the results or it is the New Year that drives the results. Right? So our story is it is the New Year because people tend to gamble more around New Year. So our prediction would be in China, when investors are celebrating Chinese New Year, which is not necessary in January or early in January, and you would expect to see this impact on asset prices in New Year's month, not necessarily in January. So that will be our test. So in this test, we use China individual and index data, and we first show that equal weighted market return does confirm that there is a New Year effect, the Chinese New Year month, which is the 22 trading days after the celebration of Chinese New Year, and in excluding the holidays, right, when the market is not open. You can see that in Chinese New Year, the market goes up typically a lot by about 6% that month. In contrast, if you look at January trading days, that's before the Chinese New Year, right? Excluding the trading days after the Chinese New Year, you actually see that the market tends to underperform, has negative but insignificant returns. Okay, so that's the aggregate level. The key is how do lottery type stocks perform after Chinese New Year's Day, right? So what we did is instead of using a lot of measure, we only use price and volatility just to make things simple because the data limitation. We find that low price stocks indeed tend to outperform in Chinese New Year's month, right? Because this is price. So if you look at low price, you want to add a negative sign here, right? Which is going to be positive. So low price stocks do better in Chinese New Year significantly, but not so much in January. And high volatility stocks do better in Chinese New Year month, but not so much in January. So we have very consistent evidence from China stocks showing that it is indeed the New Year that during which people tend to gamble by buying low price stock and high volatility stock, that stocks with lottery futures. Not necessarily in January they would buy those stocks. They actually don't, according to the results. Okay. So taken together, this article shows that it's built on the premise that investors have this innate preferences for gambling, especially surrounding the New Year. They exhibit stronger gambling mentality, which prompt them, right, to chase lottery type securities in the financial markets as a way to gamble, right? They can go to Las Vegas, they can buy lottery, but investors also can buy lottery type securities in the financial markets as a way to gamble and express their gambling attitude and bullish view, right? So what kind of securities are lottery type securities? They include out of the money call options. They include stocks with strong lottery features that has low price, high volatility, and high skewness. And we find those securities, call options, OTM calls, and lottery type stocks do outperform in January, especially in the first 2 weeks of January, and they experience heavy trading, and they tend to underperform later after January through December. And this impact is most driven by retail investors or among retail investor trading stocks. Also, we show using the China data that it is the new year during which investors exhibit stronger gambling mentality, not necessarily because it's January. It's because January 1st in the United States coincide with the new year for the American people. Okay, so that's our paper. And lastly, I'm going to spend a slide to show you our follow-up work related to the new year gambling mentality. Right? So if it's new year, that matters for people to be bullish, to engage in speculation, buying lottery type stocks. And China is one of the many countries that have New Year that's different from January 1st. So in a subsequent study, I wrote with my former doctoral student, Kelly Bursma. She's now assistant professor in Ohio University. And we look at across the world, we find as many countries as possible that have a cultural New Year that's different from January 1st, right? In addition to China, we have Hong Kong, we have I think a lot of Southeast Asian country, a lot of Middle East country, and they have different convention tradition to celebrate their New Year. And we find that using 11 major international markets with 6 different cultural New Year holidays, that's different from January 1st, we do find that stock market tend to outperform surrounding the cultural New Year, right? After we control for all of the characteristics that predict the stock returns, this New Year dummy also predict 2.5% higher monthly returns among stocks, especially among those with lottery features. So we do have the test related to lottery features there. So this is a nice follow-up work that showing that this culture or New Year gambling mentality is pervasive across cultures. It's contingent on the cultural context, and you can see actually their impact on stock returns. Okay, so that's my presentation for this